While we're waiting for the rest of our attendees to join us, I'm going to do some introductions. My name is Shane Pinnock. I run the events over at 10 Capital Network, and we have a great reverse pitch for you with Ray Johnson of Aravaipa Ventures. Ray, I'm just going to hand it over to you and let you introduce yourself and get started with your presentation.
Great. Thanks, Shane. I appreciate you inviting me and I appreciate everyone attending. I'm going to talk for just 20 minutes about investing in environmental technology companies and, in fact, environmental improving and possibly even saving technology companies. Just to give you a brief background on myself, I'm the managing partner of Aravaipa Growth Equity Fund. Aravaipa is a canyon in Arizona that my partner loves and named our equity investment venture capital fund after. Both he and I have known each other for 35 years. My brief background is I'm an engineer from the University of Michigan, go Blue, and also got my MBA at Harvard back in 1988. Together with my partner, he was my classmate, roommate at Harvard, and we've been working together for many, many years. But I'm also a doctoral candidate at the University of Florida, where I'm working on a dissertation that focuses on the success factors that allow small private business owners to maximize the value of the sale of their business. So very academically focused. However, for the last 30 years, I've been running small private businesses and doing exactly what I'm studying, raising money, growing the business, and then trying to find exits. We started our first Aravaipa fund back in 1993, I think it was. And we started our second fund and we had a lot of success with that fund. We started another fund here recently in 2021, both funds focused on environmental technology companies. My partner's based in Colorado, I'm based in Florida. Most of our investments have some affiliation with Colorado, and there's a lot of environmental technology development going on there. So it's been a really great place. The picture that you see on the screen is one of our pride and joys. It's not the cleanest, but this is a reactor that converts tires into usable oil and a product called the carbon black that's used to make more tires and made to make cell phone cases and wetsuits and all types of other things. So that's just a little bit about me and a little bit about Aravaipa. I'll go through our deck here. Of course, the lawyers request us to put up some disclaimers. Do not rely on anything in this presentation to make an investment decision. But we can provide a lot more detailed information for anyone that is interested in considering an investment in our fund. We're going to close this fund in April or May of this year, so it's almost closed. As you may or may not know, there's a lot of controversy right now with ESG investing. You may not know what ESG investing is, or many of you do, though. Environmental, social, and governance positive investing. And there's been a lot of corporate votes and even legislation to prevent companies from exclusively investing or investing a certain percentage or having to disclose how much of their investments in big funds and big insurance funds and institutional investments. However, 75% of all limited partners, these are big institutional invested, rank climate change and sustainability as the most influential megatrend when deciding where they're going to invest in the next 5 years. And it's not just because it's socially positive. They also think that it'll provide for long-term private equity returns. And it has. Over the last 10 years, investing in environment, climate change technologies has provided sort of 2x returns over most other types of portfolios. So, and this was even confirmed in PitchBook's 2020 Sustainable Investment Survey, where many people have already made these investments. In fact, if you look at my next slide, in 2019, it was a $1 trillion was invested in public markets, but by 2021, $2 trillion. And 2023, we're on track for about $3 trillion in funds being invested in ESG technology companies. Now, I'd ask everyone to think for a minute of all the ESG companies that you've invested in or that you've heard other people have invested in. Let's go through the list that comes right to the top of the mind. Tesla, and then it's very hard to list another company that's focused on something that's ESG focused. And as a result, there's just not enough publicly traded companies that are exclusively ESG. Sure, many companies can say that Amazon, they're doing things to help the environment, to help society, to help with positive governance, but they're not an ESG technology company. So there's this real demand on the one hand for the opportunity to invest in these because of returns and because of social good. And on the other hand, there's not that many public companies. On the other side, there's many, many small private ESG companies that are looking to raise money and prove technologies and build a business. And most of them are undercapitalized and they can't scale as a result to reach their full potential. So our fund is sort of trying to be the glue between it. We're trying to find a small number of extraordinary environmental technology companies, fund them, and then scale them quickly so that they can go public, either through a SPAC merger or through an IPO. I want to stop anytime if anyone has any questions. I've got the Q&A board up, so you can post questions there, and I will look over from time to time, and I will look at that and try to answer questions. So don't hesitate to ask questions at any time. Just to take a quick look, a quick overview of our fund two. Our target is a $25 million fund. We've got about $76 million under management in total on Aravaipa, which doesn't make us a big fund, but it doesn't make us a microscopic fund. We're sort of a small to medium-sized fund. Of course, there's many, many bigger. This fund is focused to be 25 million. We're allowed to bring in 100 investors. We have already about 77 investors in this fund. And this is our third fund, actually. We had fund one, fund what we call 2B, and then this is fund two. All Colorado connected, and our investments in each company are somewhere between $1 million to $12 million. Now, we've already selected the 4 companies for this fund. So the fund is, it's not a blind fund. A lot of times when you invest in a venture fund, they have a thesis, an investment thesis, but you're not sure where they're going to invest. We've already selected the 4 companies. We've deployed 80% of our funds, but we're holding reserves and we're looking for additional investors so that we can make follow-on investments in these companies. So this is what we believe is a formula to making these companies successful. As you may or may not know, one of the main causes of small businesses going out of business is just running out of money. And if they're undercapitalized, they don't grow quickly enough, and then they can't raise more money. So we try to be the backstop. And many of our portfolio companies in our fund one, we made 3, 4, and 5 follow-on investments to help support these companies to success. Our focus is not startup, it's not early stage, it's growth equity. That's that stage where the company is either generating revenue or just about generating revenue and has a clear path in 1 to 2 years to achieve possibly profitability or an exit. In fact, we've started this fund in 2021, and we've told our investors we're going to seek exits within 3 years. So that's really our commitment to relatively quickly get in and get out. And our expectation is 5x to 10x returns. Now, most venture capitalists wouldn't put that on a slide or tell their investors that because it's pretty aggressive. But some of our companies we knew well, and they were companies that we invested in our fund one. So we knew them well and we were involved with them. And in fact, my partner's the chairman of every company that we've invested in. So we have some level of insight and possibly even control. Now, we only invest if these companies meet 6 really proven criteria that we have. And I'm going to talk about those in just a minute. So we're looking for companies that have capital that have capital needs that will allow them to grow rapidly, quickly, and find an exit in that short time frame. Here's my partner, again, my roommate from Harvard. He graduated top of the class. I graduated in the middle of the class, but we're buddies and we've been working together for 35 years. He's had a lot of success in private equity and sold a $100 million private equity group a number of years ago. And also Tim Reeser, who is the CEO of Lightning eMotors. It's one of the companies in our portfolio one that went public 2 years ago through a SPAC merger. And this is a publicly traded company. It's a company that makes commercial electric vehicles. So everybody hears about private passenger commercial vehicles. Tim's company that we invested in had a lot of success with, makes commercial electric vehicles. So he's also on our committee. Here's the 6 criteria that I alluded to before. And it's interesting if you drop all the way down to the bottom of this slide that when we look at environmental technology companies, less than 5% of every company we look at meet really even the first 2 criteria. The first 2 criteria are the toughies. And the first one is that it has a strong and simple story with distinct environmental technology content. Now, I've invested personally in a lot of lab technologies, and these lab technologies are for protein measurement, synthesis, et cetera. They could have a huge impact on the medical industry, on health and welfare. But these instruments are so complicated, you could never go public with these companies easily because it's not something that would resonate with investors. It's too complicated of a story of how they make money. So we're looking for something like Lightning eMotors, the example I gave before, commercial electric vehicles. Okay. The other one I showed at the beginning that recycles tires, recycles tires into oil. Something very, very simple. And the other critical requirement is that they have the potential for a $5 billion total available market and to achieve 100 million in revenue within 5 years, once properly capitalized. So there's many companies that will grow to 50 million, 40 million, 60 million. And we've invested in those. Our fund one was an early stage fund. But for this fund, we're only talking to companies that have a $5 billion market potential and can achieve 100 million in revenue within 5 years. So it's a pretty strict. Now, these other criteria are equally important, but the first two usually knock out most technologies that we've looked at. We want validation. We want to see that the company's already scaling, that they already have revenue, they have customers, strategic partners, and co-investors. We want to invest alongside other smart people, other smart venture capitalists or strategic partners. So every one of our investments has that. We need a CEO who's ready to be part of a public company. If we're going to take this company public or find an exit within the next 2 years, we have to have an extremely strong CEO and also an extremely strong CFO. And if the path for the company is to go public through a SPAC or an IPO, the CFO has to have public company experience. Now, when we first meet a company, it may not have that, but then we help the companies recruit and actually fund paying for a top quality CFO. We bring in an audit team, we help them select accountants, lawyers, and structure this so that these companies are ready to exit through the public markets within 2 to 3 years. Okay. The valuations, we really love battery technology, and we've looked at battery technology for over 10 years. We never found until this fund a company that wasn't worth $500 million before they even made their first battery. And we found a company, we've invested in one battery technology company. The valuation was 30 million. We thought it was very reasonable. We helped the company merge with another company. We've increased the value. We've recently made an additional and follow-on investment. Our first investment was 5 million. Our follow-on was 2 million. So we're looking for companies that don't have these sky-high valuations. They have something reasonable that will allow us to invest prior to going public, that allow us to achieve the 5x to 10x return. And we did that with Lightning eMotors, with our electric commercial vehicle company. We allowed our investors to come in at $1 a share, and the company exited over $8 a share through a SPAC merger. So those are the types of things. But at the same time, we want strong downside protection. That's why this is not a startup, early stage fund. This is a growth equity fund, later stage. And then again, these companies have to be ready to complete our exit process within 3 years. But of course, as I mentioned earlier, we help them through that process. We move them through it. Okay. So again, 1 to 12 million. We lead the funding round. We're usually the lead investor. We propose the term sheet. We prefer senior preferred equity or a convertible note. Again, we're always looking for strong downside protection. And then we want to have board representation, if not as the chairman, at least 1 or 2 of us on the board. And then we want to make sure that we have sufficient capital left over to fund the company, either through an IPO, SPAC merger, or a sale to a strategic. And that's why having co-investors that are strategics is really critical. We used to only look at companies that already had or that could get, along with our investment, a strategic co-investor. And that happened at the company that recycles tires. We've got a number of strategic investors, but we've also had some financial investors. But we want other smart people that believe what we believe and that co-invest and that can make additional investments down the path. That's the best way to provide downside protection, is to make sure that you have other investors that are willing to invest through the process, not just one and done. Okay. I don't see any questions here. I must be doing a good job. Our phase 3, after we select companies, after we invest in the companies, our phase 3 is that we manage them. We're not passive investors at all. We work closely, as I mentioned, selecting auditors, selecting lawyers, helping recruit a CFO. We sometimes act as the acting CFO until the CFO can be recruited. We help with every aspect of modeling, cash flow, fundraising, partner strategies, et cetera. We get deep into the nitty gritty on legal documentation, et cetera. So we are going to be actively involved through that 2 to 3 year process to help ensure success with these companies. And because we only invest in 4 or 5 companies in each one of our funds, we have the time and the capacity to make that time commitment. This is a list of the 4 companies that we've made. The tire recycling company is called Boulder Industries. They convert about 98% of used tires back into their raw materials. Our Fund 1 invested in this. As I mentioned, my partner, Robert, is the chairman. We've invested $10 million into this company, and we own about 10% of it. We think that they'll be ready next year for an IPO, and we've been working on it. They've had some SPAC offers to merge with a SPAC, and they've also had some strategic offers to be acquired. But we think next year we'll have the ability to IPO or possibly sell to a strategic. Psionics is the battery company that I alluded to. They've got some very unique technologies for silicon anodes. It's something very unique. They're working with some other top battery companies that need their additives. This company started out as an additive company, not really a battery, company, but they make additives in just one small component of the battery, which is the anode. So we've made a $7 million investment in that, $5 million last year and $2 million just last week, so that we're at $7 million with this company. So we have about a 10% ownership, and we have options to increase that. We think that company could be sold this year. The positive progress they've had with a strategic partner recently, we'll find the final results this month, and they could be acquired this year for something like 3 to 6x our original investment valuation of $30 million. Spout's a company that hasn't come to the market yet, but they've got some really great technology out of the top university on detecting lead in drinking water. And you may or may not know that the Biden bill for the environment has passed a very substantial amount of dollars towards detection of lead in consumer at-home drinking water. So this company will be the first device on the market that will be able to do that. They're working really closely with Amazon. They've got a strong strategic partnership there. We've only invested $500,000, but we've got a big option to invest another $1 million to $1.5 million. And the third one is Clear Comfort, which is a company that's from our Fund 1. So we've known it for 6 or 7 years. They make a system that eliminates chlorine from pools. And the water is effectively like drinking water, but no bacteria grows in it. So it's a really unique system. They're in commercial pools, residential pools, and they're in the process of merging with another company where their technology was licensed from, called Silver Bullet. And that uses the same system for livestock drinking water. So it's for chickens, cattle, pork, fish farms, shrimp farms. They make systems that purify the water and make the livestock grow, and also for vertical growing. So whether it's cannabis or other types of horticulture where they're growing in closed environments, it's really important to have extremely good water without chemical additives. So Robert's the chairman of that company. We've invested actually $1 million in that in Fund 2, and Fund 1 we invested about $3 million into it, and we're looking to invest another $500,000 once this merger is completed. So those are the 3 companies. This is just some additional details on the company. I'll go through that, but this is our first factory in Maryville, Missouri. We've got a second factory for Boulder Industries that's going to be online this year in Terre Haute Industries, one of our largest competitors. $125 million invested, could never produce or recycle any tires, and we were able to buy their $45 million factory last year for $9 million, and we're converting it over now to our technology. So we'll also have a factory in Belgium in 2024. We've already sold out all the oil and all the carbon black that we produce for 4 years from both of these companies to top customers like Pirelli, Michelin, et cetera. So we think we'll do about $50 million in revenue in 2024 with massive gross margins, and in fact, very, very big earnings margins as well. Any questions? Psionics is the battery technology. There's a lot of companies out there, as this graph shows, pursuing different types of technology. We're focused, I jumped ahead. We're focused on this segment of the market of silicon anodes, in addition to providing electrolytes that optimize the performance of these electrodes. So the largest electrolyte company in the world, based in South Korea, is called Enchem. They're our co-investor. They're a strategic partner. They're a potential acquirer. Very, very important supplier, because some or if not most of the best batteries in the world are made in Korea. And they vetted this technology, which encouraged us to invest as well. So we believe that one of the technology partners that we're working with now could acquire this company because our technology will be so critical to their success of their battery production. And as many of you have heard in the news, Ford's building plants, GM's building battery plants, Mercedes, all the big auto companies. But then there's everyone else, Dyson and Black & Decker, and everyone else needs new battery technology. So this would be really revolutionary. We're a fraction of the cost, and we're a multiple of the existing power capacity of the existing batteries that are out there. The most important thing about this battery technology, and the thing that we loved about it, wasn't the valuation, it wasn't the technology that I mentioned. It was really that their technology drops in to existing manufacturing lines. For a gigaplant, $1 billion battery manufacturing facility would cost less than $1 million and take less than 30 days to convert over from their existing technology to ours, because we're just changing the anode. It's the same shape and size, and we're changing the electrolyte, same liquid quantity and so forth. So this is a drop-in technology, which makes it very attractive to people that have factories built, whereas most of these other technologies that are up and coming that don't have the cost performance curve that we have, they have to build brand new multi-billion-dollar factories. So this makes Ionics very attractive. This is Spout. Very, very important. Again, there's a $30 billion bipartisan federal EPA grant to find and replace residential lead pipes. And with that, there's also money to fund the detection. This company will sell B2B. It'll be selling to municipalities, big water municipalities all over the country that want to be able to detect and then also monitor and also store the data. So this system detects the water, uploads it to the internet. We create a giant profile of neighborhoods, communities, towns, cities of where there's lead in pipes. And then we can monitor after remediation that lead is eliminated. So this is a massive market. This product, again, hasn't been launched yet, but it'll be launched in the next couple of months. And we expect it to go very, very quickly. We think by 2025, they could be 45 million in revenue with extremely high gross margins. Clear Comfort is the company that purifies pool water. They use something called advanced oxidation process. There's can be a small amount of chlorine in the water, but it's less than drinking water. And they just closed in December. The reason we doubled our investment from Fund 2 is in December, they closed a major agreement with one of the largest spa jacuzzi companies in the country to exclusively use their device on all theirs. It's not going to be an option anymore. It's going to be their standard device. So this company is rapidly growing. And in fact, their forecast with this merger is really closer to 12 or 13 million this year. We think it'll be 25 million within the next 2 years. And at time, we'll look for an exit on this company. Okay. So I mentioned a little bit about our prior two funds, Aravaipa Fund 1, Aravaipa Fund 2B, and Aravaipa Fund 2. Very similar, except that this fund is a 3-year fund. We're making a limited number of investments, and we're targeting a 5x to 10x return. So that's the difference from some of our other funds. Our first one was a 15-year fund. So we invested in very early stage technologies. Okay. Second to last slide. These are, again, just to remind you, some of the reasons that you might want to consider an investment. Talk to us further, get more information. We think there's a very high potential exit opportunity for environmental technology companies. There's a huge demand in the public markets, but there's just not enough public companies. We've had over 15 years of experience investing in environmental technology companies. We've already identified the 4 that we're going to invest in, and we've got them well on their way. We have complete confidence that we're going to achieve 5 to 10x return in 3 years. For people investing now, it's really 2 years. And, you can do well, but also do some good. We think these companies will have a huge environmental impact. So that's this quick story on our Aravaipa Growth Fund 2. I'm very proud of it. I made a massive individual investment in Aravaipa Fund 2, as my partner has too, on the tunes of about $1 million each. So we put our money where our mouth is. And we encourage you to contact me at the email address below or through my phone number here if you have any questions or if you have any further interest. Is there any questions right now? I don't know if we can open up the microphone, Shane, to take questions verbally.
Yeah, so that's for our audience. If you have any questions, again, you can put them in the chat at this point, or if you raise your hand with the little Zoom feature that goes like that, well, we can also turn on your mic and you can just ask your question freely. So let us know. And also, Ray, if we have any questions that come in afterward, I can just send you those via email and post it as well.
That's great.
You know, also what I need to do is run our little poll here. So for our audience members, I'm going to release a poll and you can indicate your interest level in Aravaipa, and we'll take interest that way as well. But thank you so much, Ray. If there are no other questions, we'll move. Oh, we have one now. There we go. Sam, I'm going to allow you to talk. All right, Sam, you can go ahead and ask your question.
Oh, hello everyone. I am Samuel Coppell. I'm based in London, UK, and we are. Yeah, can you hear me?
Yes, I can hear you. There's a little bit of background noise, but not too bad.
Okay, all right. Yeah, let me cut off. Okay, so I left my on the discussion tab. I left all my contact details, my email address, and my LinkedIn profile. We are an asset management company. We're based in UK, and we are Unifund PLC. We are a traditional asset management company. We hold capitals from high net worth individuals and corporate clients. So yeah, we're looking to get into this fintech, into tech investments, AI, and crypto investments. So yeah, we're looking for nice project, sustainable project where we can accelerate, of course, the project and the company, and we're looking for someone who can give us also an exit strategy for our investors. Yeah, so if any interesting projects with a nice pitch deck, with a nice preparation, we can be interested in investing. And yeah, that's all. This is
great. What are your minimum investments? And
oh yeah, so we have we do also some family office, and the minimum investment it's 500,000. So we're dealing with high net worth individual investors. But we start at 500,000. We are investing into startups since last year now. Yeah, so
Okay.
we've done some investments with some of the young team we recruit to Unifund, and it looks interesting. It looks good. It's a very interesting market. It's a very disruptive market, and we definitely want to have some more allocation there.
Great. Sam. Well, I'll follow up with you after this call. Thanks for your interest. I think we've got some very interesting stories to give you, and I'll send you a few decks. So
that would be great. That would be great. Awesome.
Yeah.
Thank you very much.
Great. Thank you, Sam. If anybody has questions, you can follow up with myself or Ray, and we'll be sending out follow-up emails after the event directly to you. So if you have questions, we'll also have the recording in there, and you can review it, and we'll get your questions answered, and we'll follow up with you. But thank you so much, Ray. Is there anything else you'd like to add?
No, thank you for your time. Appreciate everyone's interest.
Right,
and please follow up with me directly. Glad to send this deck out and other decks if people are interested in individual companies. I will say that there are some direct investment opportunities, both for Clear Comfort Water, the pool purification company, and for Spout. They're looking for some direct investment, but if you want to diversify, you could invest directly through our fund and have an investment. One thing that's really interesting when you invest in a fund like ours that was established more than a year and a half ago is you get the valuations that we locked in a year and a half ago. And although the economy is down and valuations in general are down, these companies have posted revenues, they're posting earnings, they're making progress, and their valuations are up. In the example of Boulder, our investment was $150 million pre-money, They're about to close an investment round right now at $400 million. So it's almost a 2.5x return if you invested today just on your Boulder allocation in our fund, which is about 40% of our fund. So our fund is well on its way to providing attractive returns to investors. We've got work to do to get to 5 to 10x, but the 2 to 3x is looking like it's money in the bank. Hope that makes sense.
Yeah, no, sounds great. Thank you so much for sharing. And if you don't mind just staying on, you can pop back in after our pitches and stuff, but we'll have you give some feedback as well. And also for anybody who's listening to this recording after the fact, again, you can send an email in response to the follow-up and we'll get your questions answered. Also, any interest you have, we're happy to set up introductions. Anything you need, just let me know. But thank you so much, Ray. And with that, I'll bring up Sean from Botrista to give his presentation.
Hi, everyone. My name is Sean Xu. I'm the co-founder and CEO of Barusa Technology. We are the leader in beverage automation, and today we are basically looking at closing our Series B, and then we actually started to initiate our Series C pretty soon. The background of our business in the United States, as complex and crafted beverages, which is healthier, better for them, and as a result, the entire on-premise market in the United States for non-alcoholic beverages is actually reducing significantly. Today, we will look at the entire market in the US. It's a $70 billion B2B business opportunity on on-premise non-alcoholic beverages sector. And fun fact, Coca-Cola is a huge player in this game. Now they only have 5% or less of the market share because consumers are looking for, again, healthier and better for you, customizable craft beverages. These are the drinks that the younger generations are all taking in now, right? It's like Starbucks, any pink drinks, cold beverages, like a frappuccino, smoothie, or anything you can imagine in a Dutch water or Starbucks. This is actually moving in very fast in the industry. Even at Starbucks, more than 70% of their revenue is actually from this category today. And as a result, this is all coming up really soon, but at the same time, the labor force in the United States is actually not keeping up. All the restaurants are facing the exact same questions and problems today. They're all seeing a decline in soda sales. They're all want to sell something fancier, healthier, and crafted. But at the same time, it's really, really hard to hire and train for the labor. So this is what we do. We create a drink bot. This is a machine that can basically make any Starbucks level beverages in a footprint of a fountain machine. It's not just a machine, it's really an AI beverage director because we collect all of the customization data. We serve all the top tier customers now, and with all this international and domestic data, we know exactly what customers are looking for, given the demographic and geographic. We cover all of the categories from crafted iced tea, flavored lemonade refreshers, all the way to plant-based milk, coffee, frappuccino, smoothie, aquafasca, cocktails, mocktails, smoothie, milkshake, energy craft drink, anything that you can imagine that is crafted. And it's as easy as, even my grandmother can operate this machine. So this product is actually now launched in the market. We are in 26 states. The background of myself is basically I'm a serial entrepreneur. I'm also an investor. I do early stage and Series A investors. My background is a mix in robotic and automation, plus operation in Starbucks and coffee shops. So our family own a couple Starbucks and couple coffee shops. At the same time, I've specialized in fluid dynamic, robotic, and any kind of automation. I was at Tesla 10 years ago after I sold my first company, and then was doing a lot of 0 to 1 phase working with Elon Musk. So the mix of robotic and beverages leads to where we are today. The team is formed with a lot of food and beverage experts with a very solid engineering team to develop all the cutting edge technology that we win all of the top tier award across the world. And today we have a lot of tier 1 partners actually working with us, including Middleby, Sony, and Rich's Food. The key value proposition in our business is very simple. It's basically we increase beverage profit for restaurants. Across all the 26 states that we deploy, we all see that every single restaurant we deployed, they get a additional 20% of net profit increase. There's no cannibalization of any existing soda sales. And this is pure additional profit. We're selling in a profit center and no one actually turned us down. So the growth of our business is very, very rapid. We only launched the product a couple months ago and now we are in almost all the states soon. This is a good example on the case study, right? Like Halal Guys as a chain restaurant, they only have soda for decades, but now they can sell very fancy crafted lemonade refreshers, iced tea, and this is another account, ice sandwich, very similar, but they do cocktail, mocktail, and also iced coffee. These are the programs that we actually see an additional 30, I would say 20 to 30% net profit increase as a result. Like it's a pretty big mover, and it's actually a strong motivation for all these operators to actually adopt a new program to expand their beverage menu without adding additional labor. So in terms of the business model and our growth, we do a B2B SaaS and RaaS business model, and we let the customer to subscribe our entire consumables as well as the software as a service. This is proven that it's very easy to scale because it's high recurring revenue and very low OPEX. And we deal with all the medium-sized chain restaurants. So as a result, today, one of the biggest value that we compare with any existing solution on the market is we not only expand their beverage menu, but also make it very easier to fund the machine to operate. As a business, B2B business, we actually can generate 6 times more profit than any traditional soda machines. The key secret behind this is because of our core technology. So our technology basically has an AI beverage director piece as well as the deep tech in dispensing. The AI beverage director actually collect exactly what, when, and where, and customization preference on every single drink. With this AI, we can now predict exactly what customers are looking for, the trend, and the recommendation. This is a good example of a beverage menu that we can come up with from our AI system. It's basically compare the perfect non-alcoholic beverages menu for different kind of restaurant or cuisine type. We also collect a lot of third-party data by using ChatGPT and other existing database online to look at specific flavor profile that is trending in specific regions. And all this will come up with a result that we precisely know what consumers are looking for different market. To deliver our beverages, we develop a core technology, is algorithmic dispensing technology. This technology is a software-based technology that can dispense any liquid with a very simple hardware. With this technology, we can now service high quality products with a very good margin. And basically the secret is between, puree, which is a dehydrated juice, versus syrup. We are the only player that can actually dispense puree or anything thicker, high viscosity than puree. Anything in this category can have a better for you, healthier, more natural ingredients in this actual product. And at the same time, when you look at the entire spectrum of ingredients, we can cover not just soda syrup, but everything else that no one else can handle, including cane sugar, honey, or any juice puree. Currently, we have more than 100 patents filed globally, and most of them are actually granted. So as a result, there's no one else actually have this technology. To deep dive a little bit more here, it's a technology that actually can fulfill multiple requirements in the F&B operation world, not just by the size, the cost, but it's really on the accuracy and speed. Moreover, the important part of the food automation robotic space is about the certification for food safety. We now have passed all of the FDA, USDA, and NSF certification, and we are now in mass production mode. This is a little deep dive. Happy to answer more questions on this, but this is a quick little showcase on how accurate and repeatable our technology is compared with all other technology on the system. We can do plus and minus around 2 sigma to 4 sigma. All other competitors are doing approximately plus and minus 50 to 60% inaccuracy. With this core technology, the most important piece to me personally is sustainability. In the United States, shipping bottled water or bottled drinks is actually consists of 12% of the carbon footprint of the entire agricultural industry. What we are doing is essentially moving that logistics to something that is more concentrated in a natural way. So every single cup, we are saving approximately 8 to 10 times on carbon footprint, which as a result also reduce our shipping costs and give us a very, very good, healthy gross margin. Our consumables gross margin is actually better than most of the SaaS companies. It's all because of this core technology. So finally, the growth side of our business today, we are looking at a market of total obtainable market by 2030 is more than $40 billion. It's mainly in these 6 regions. Today, we are in the United States. This is what we have done so far after we built a sales team for less than 6 months. We have more than $21 million ARR signed. We have more than $460 million ARR in the pipeline. We have been testing with the leading players like Starbucks, Wawa, Jamba Juice, and there are more to come. So as a result, today, the whole success is actually come up with our advanced technology. We spent almost 4 years on getting ahead of our players or competitors. We start with a 6-axis robot, moving to 2-axis all the way to where we are today. It's a very fast, easy to operate, and small machine that can make any craft beverages with this automation technology. We call this the Tesla in the beverages, or Apple in the beverage industry, because this is a best user interface product. No one need to read the manual in order to operate the machine, and that's the secret of where we are on fast scaling. Compared with any robotic company in the industry, we are absolutely way better in cost of capital, because the cost of machine, which is the capex, because of our technology, our payback period is way less than 3 to 6 months. But at the same time, our recurring revenue is very stable, and our gross margin is extremely high compared with all other players, because the machine is very easy to operate and very low OPEX in maintenance. So as a result, this is where we are today. We are all for basically surpassing Coke and Pepsi on the on-premise non-alcoholic beverage sector. It's a very, very big industry. We are targeting with a SOM of $40 billion. It's already proven in 26 states, in hundreds of locations. We signed more than thousands today. It's all carry over with our high barrier of entry and our AI beverage director and the data we are collecting today. Happy to answer any questions or any comments on our business. And yeah.
Yeah, Ray, if you'd like to get us started with some questions, and in the meantime,
Yeah, I've got some questions. So Sean, it's one of the better presentations I've seen. It's one of the better business concepts that I've seen. Congratulations, well done. Good job on the slide. I'm pretty critical. However, there's things that raise questions, and you don't have to answer these. You can just send them to me later, or you can answer them if you'd like to now. Like, I've never seen a company at your stage with 100 patents. That's millions and millions of dollars. I've prosecuted patents around the world. Maybe you're talking about PCTs and you followed them in provisional patents, but even that's a ton of patents. It seems like an exaggeration. The $300 a month of the competitors generating on a beverage machine, a lot of those machines generate $300 a day. So I don't know if that was your cost that they're charging, or if that was the revenue they're generating. I wasn't sure on that. Maybe you can clarify that for me. You said yours was 1,200, theirs was 300.
Yes, so we generate in most of the medium-sized chain restaurants or fast casual restaurants, they typically retail at $4 or $5 per cup, and then we basically generate approximately $1,800 a month in ingredients sales.
Right.
For other soda companies, they basically sell similar model, the consumables, the restaurant at $300 per month. So that's a B2B part of it.
All right. Well, that wasn't clear, but you got to be really careful in presentations about exaggerating or slanting things too much to say you're going to beat Pepsi and Coke. They're just going to acquire you if you even become 1% of what they're doing, because if you're talking to institutional investors, they're very sophisticated. If you're talking to mom and pops, they're very skeptical. So I would caution you to make sure that when you put out these huge differences and these huge statements, hey, it's great to be ambitious. It's great to have a great vision, but be realistic. Make sure it's all founded in reality. And the most important thing on every deck, and if some of have been on presentations where I've critiqued before, I say the same thing every time. The three most important things that people want to hear, most people don't put in the deck. You talk about the massive market, how great the technology is, how bad the competitors. What we really want to hear is exactly, very precisely how you make money on each machine and each thing of syrup. I don't need to see a big hockey stick curve of revenue and growth. I need to know very specifically how you did that. And then show me an example. Hey, we got a contract with this guy. And then show me that you've got 10 of those contracts. And then show me that's going to add up to 21 million in ARR. Really explain it to me with your costs, because you may have the greatest machine in the world. I invested in a machine that dispenses hair dye. It's the greatest machine in the world, but the costs are so high that it doesn't matter. So you got to tell investors exactly how you make money, and then you have to tell them exactly how they make money. What's your valuation? If I invest 100,000 today, when do you expect to exit? What do you expect your exit multiple based on comps and other companies like yours? And what's my multiple going to be? So if I'm investing today, in 4 years, I'm going to get a 10x. So you got to tell us how you make money, how we make money, and then tell me all the reasons it's really good downside protection, why I'm unlikely to lose my money. You infer it with this beautiful looking team, very impressive, all this great technology, even your background's very impressive, but you have to tell investors at the end exactly what would happen if everything else that you're dreaming doesn't happen, and why it's very unlikely that they'll get their money back. 3 simple points. Most people don't include it, but you really should, whether you're talking to institutional investors or individual investors.
Yeah, totally. And that, let me cover these 3 real quick, right? So number one, the way we make money is we do B2B business. We lease a robot, charge the SaaS, and then selling the consumables. Our consumable business is way better than any soda company. So to be fair, the reason that we include those slides about these soda companies is because we actually get reached out by their M&A team a couple of times. And we keep turning down because we know it's selling too early. And I personally sold a company 15 years ago already, so I'm not looking for a small exit. I'm planning to go NASDAQ and then bring the company to a $50 to $100 billion valuation. That's my passion. And to me, it's really to kind of enable a better future in beverages and more sustainable.
Okay, I love that. 100 million valuation. You're going to achieve it when? 2024, 2025, 2026?
I'm talking about a $100 billion valuation. Today we are at a $100 million valuation. Yes.
Awesome.
So,
so your valuation today is 100 million.
Today's post money is at around $100 million on our Series B, and so it's a pretty interesting journey. I'm looking for whoever. Well, first of all, we have all of our Series A and B, and all the rounds are all oversubscribed. But I'm just looking for someone who are passionate about building a company that it can worth $100 billion with me. So that's kind of the quick background on that side. In terms of downside protection, I can tell you that we already turned down 2 M&A deals in the past 2 years. One is the leading company, NASDAQ listing in food equipment manufacturing. They absolutely want to partner with us and then look after the technology. That's one deal. And another one is a leading coffee company, I would say top 3 out in the world, that they also give us the offer, but we also turn it down. So downside protection, I think there's a lot of ways to look at our business. But net to any investors or any businessman, right? Our business can be profitable in any time. You tell me like, okay, Sean, make it profitable, and I'll say, okay, great. In 9 months, I'll make it a EBITDA positive or cash flow positive business in 6 to 9 months.
Yeah, no, profit's not important. Growth is important. Yeah. Top line is important, and gross profit margin. That's why I say you need to break down your financials. So, do you mind mentioning who the other venture capitalists that have already invested with you are?
We have Pinnacle Capital, TGA Capital, Happiness Capital, and the majority of our partnership is from a couple CVCs, including Rich's Food and Middleby.
And what would you say the average investment from the strategics and from the institutional investors? Has been?
I have them kind of split up pretty healthy. So most of them have approximately 5 to 7% of the company.
Well, how much have they invested? Did they invest?
Total raise. So each of them do like, I'll say $3 to $8 million check.
Okay. All right. So you've got some decent investors. Has anybody invested at the 100 million valuation? Because that's pretty high valuation for your stage.
Yeah. So going back to the multiple topic, right? So in this field with this recurring revenue, most of the multiple, it was around 15 to 20 times of the revenue, but now the market is bad. So it's like around, I would say 6 to 10 will be average. So with our signed contract, $21 million now, it's very firm. And to be honest, this deal is pretty much, we're closing in 3 weeks. So we already oversubscribed. We're looking for anyone who want to just work with us, and then we're closing pretty soon. The series, so by year end, we are going to sign more than $50 million deals, and next year will be $100 million. So between these 2 years, we will find another Series C lead investor to set another new valuation. We're expecting having that conversation by around Q4 this year, when we have like around $50 million signed deal. The valuation can range, from 5x of that to 10x of that, which is $250 million to $500 million in valuation.
I mean, I'm not sure about your industry, but what I've generally seen, it's 5 to 10x historical revenue, not projected revenue. So, because projections, unless your contracts are locked solid and nobody can ever get out of them, nobody can cancel, it's usually historical revenue. So, but what you're telling me is nobody's invested yet at 100 million valuation. That's just what you're seeking.
Oh, they already invested in. So Series B, so it's already closing 90%. So we are raising $30 million, and $27 million is already in the bank.
Series B is 30 million.
It's 30 million. Pre-money $66 million, and post-money at 100 million valuation.
Oh, okay. I see what you're saying.
Yeah.
So 66 pre and 100 post.
Yep.
Great.
Okay. And 90% subscribed.
We'd be happy
Yeah,
to
90% is close.
introduce you and further the conversation there, but I want to make sure we have time for our last presenter as well. If anybody else, again, has questions in the audience, let us know, and we can get those answered for you as well. But thank you so much, Sean. And like I said, we'll make the follow-ups as necessary.
Cool. Thank you, guys. Have a good one.
Yep. Thanks, Sean. Yep, Bentley, come on up and we'll have you pitch next. Whenever you're ready, you can just go ahead and share your screen.
Okay, cool. So first, thanks for having me. Thanks, Shane and Sam, and of course, Hall, for having me, and nice to meet everybody who's on the call here, and everybody who's listening into the recording. So I usually find that it's best to give a little bit of my background and how we got here and how Way was born before diving into the actual product itself. So I'll just do that really quick for a few minutes. So my background, my journey really started when I was in college. A professor of mine told me that 2/3 of people in this country were going to live a life of pain and suffering due to preventable chronic conditions. And that stopped me dead in my tracks. I'm an Eagle Scout. I took an oath to do duty to this country at a young age. And as sappy as that might sound, or as messy as things are as they are right now, I always took that very seriously. And so I knew that from that moment that what I wanted to do is to impact health with my professional life. And so my first love actually in college was in body movement, functional movement, and helping people move in alignment with their natural structures, and seeing how when they did, they would report back saying that they were happier and they're better to their spouse, to their partner, to their friends, to their coworkers, to the strangers on the street. And that gave me a real deep sense of reward. And so what I wanted to do with my professional life was to be a doctor, but my mentor, who was a doctor and an Olympic athlete trainer, said, don't do it. It's not what you think it's going to be. You're going to have to care for people the way that the system wants you to, not the way that you want to. And so I went to the business side of healthcare, thinking that I'd figure out how to learn the healthcare system from the inside and make change from the inside. And so started my career at KPMG, audited Medicaid for the state of California. Went to Beckman Coulter, which is the first company that did blood testing on humans in a reliable, scalable way, and lab touches everything in healthcare. Ended up being #1 in the US for Beckman at a really young age, and running all of New York at a really young age, and realized that corporate healthcare probably wasn't going to be how we were going to make a big shift. And so I went into building companies. The first company was a venture-backed laboratory management services company that ended up exiting the private equity. And the second one was a consumer digital marketing firm that was partners with Google and Optimizely, as well as we had amazing clients like One Medical, Healthline.com, MedHealth.org, et cetera. But ultimately, neither of them had an impact on health, even though they were successful businesses. The second company was an Inc. 500 company, et cetera. And so what it came back to was this observation that I had since I was in college, and after studying the human body along that whole time, was that nutrition is the single biggest factor to each person's overall health. And that's not really debated by pretty much every scientist, every doctor, every dietitian, every trainer. We all know this. And so the question is, what do we do, and how do we actually get people to shift? And so what we did was, there was, alongside of that career, I was a trainer at Equinox in New York, and there was a technique, really kind of a fundamental truth that my mentor had taught me, which was that you can't really tell somebody what to do and have long-lasting change. They might change for a little bit, but ultimately, the biggest and longest lasting change will come from teaching and guiding people, to showing them what they're doing and allowing them, kind of nudging them with the right information to make their own decision. Because when they own the decision, the shift lasts for a lot longer. And so there was something really simple that I would do when I was at Equinox with my clients. I'd bring them in to create emotional rapport, that sense of trust, that sense of a safe, non-judgmental environment, and ultimately neuromuscular mirroring, so that I could help them decide how to make the change. But it sounds really simple. I'd say, hey, Ray, how was your day? What did you do? How was the stress? How are the portfolio companies? How's that guy Bentley? Was he being a jerk? Blah, blah, blah. What did you eat for lunch? And invariably 3 things would happen. The client would become aware of what they ate when they wouldn't have otherwise. 2, they immediately knew whether what they ate was good or not good for them. And we can talk about those levels. And 3, they knew by 5, 6, or 7 o'clock at night, or the next day when I would be working with them, how their body felt as a result of what they ate. And so they already had the information, they just needed to become aware of it. And so I would write it down. They would go about their day being more curious about what they did. And we'd start seeing these shifts that would happen. And about 6 years later, when I was building the predecessor product to Whey, we found that over 80% of those clients had kept that shift at 6 years, which is a really high percentage. And so also found that in that process, that intuitive eating dietitians, the best dietitians in the United States, as well as the best behavior scientists from Columbia and Duke at Dan Ariely's Center for Advanced Science, everybody has the same kind of behavior science approach to this. And it was basically the same as what I had been doing naturally. And so that's how Whey was born. So kind of diving into what it is, the problem that we're really solving is that there are over 120 million Americans, 49% of the US adult population, that are on a diet or weight loss program at any given point in time. And 83% of them on the low end fail. Some studies go as high as 95 to 97% failure. And the reason why they fail really is because restrictive diets are telling you what to do. They're creating restriction. And what happens is there's a cycle of that restriction creating deprivation. And that deprivation is just a matter of time before it breaks and turns into binge eating. And that binge eating almost invariably turns into shame and or guilt. And when you have shame and or guilt, what causes at the end of that is more restriction. And so that cycle just starts repeating itself. But even considering that, consumers are still actively seeking change. They're just met with really suboptimal choices that don't really address the entire experience of the relationship with food in the body. And so that's really what Whey is. It's reinventing nutrition mindfully. It's an intuitive nutrition platform. Again, it's really looking at a kind of Socratically surgical approach of taking intuitive eating substance and putting it within behavior science, or what we say the cognitive behavioral therapy model. So thoughts lead to emotions and feelings that lead to behaviors that reinforce the thoughts. And so we're really getting up behind the thoughts and emotions and feelings, behind the relationship with food, and allowing people to make their own decisions and really see what they're doing so they can make powerful change. It's important to note pretty high up what Whey is and what it's not. Obviously, we all know that diet and weight loss, which we're not in that market, but that market is very noisy. And so how do we distinguish from it? We're in a safe, really most importantly in Whey, we create a safe, non-judgmental space. This is really important because we get people into parasympathetic nervous system. When that happens, they're in a much more relaxed state, and they're able to reflect, self-explore, and actually create more powerful change. As well, we're extremely accessible at $6.99 a month or $49.99 annually. We make it really easy for millions of people to get access to this very high quality and previously very exclusive methodology. We also are working within proven modalities. So we're working within intuitive eating, has over 150 clinical studies behind it. And cognitive behavioral therapy, although we're not claiming a one-to-one with cognitive behavioral therapy, cognitive behavioral therapy is one of the most well-studied and bedrock forms of behavior change and mental health, generally speaking. What we are not is we are not any sort of shame-oriented cycle. And so we know that the shame and the guilt and that sort of those tactics and techniques and restriction create that restrict binge cycling, which ultimately creates that vicious cycle, which creates failure. And so just to kind of give you a glimpse of what the product is, users start on a journey. There are 54 core modules. We're expanding that to 162 right now. And really they're self-guided. And so we make it really simple, really fun to have really thought-provoking sessions and questions that are 2 to 8 minutes long and really easy for people to do, and then asking deeper magic wand behavioral questions behind that. As we move forward, what we're really focused on is extending the user lifetime through generative AI. This will really help deepen the personal experience, and that's really what we want to do as much as possible. What we've done so far, and then just flashing up just a taster of what the traction is so far, and I think that this captures a good amount of it. We've been focused since we launched last April predominantly just on the quality of our unit economics and retention, not so much the volume growth, right? But we still have gotten enough volume growth with over 2,400 customers to know that what we're seeing on the statistics is really valid, and we're ready to scale. And so we've also, I think most importantly on the left, you see that we've increased retention from 45% all the way up to 78% on a blended monthly basis. And compared to top apps out there, so MyFitnessPal is about 14% monthly retention, and MapMyFitness is at 22%. So discounting for scale, it's definitely something. Actually, our head product advisor was the head of product for MyFitnessPal, and he's the one that when he looks at our retention says very clearly it's one of those where it's even discounting for scale, it's going to be sustained and something that we can grow off of. And so when we look at also too, just from the acquisition side, we've gotten our CAC down to $10.19. So we've gotten it down 82% over the last 8 months. And we think we can get it even a little bit lower, but we're already in a positive ARPU CAC place right now of over 2 to 1. The reason why we're so strong, and I think we've generated the traction that we have, is because we have this team that's about as good as it gets in the United States, definitely the category defining team with deep knowledge and behavior change. And really the main thing is that we're all collectively aligned on this mission. From our Kara Harpstreet, who's one of the main thought leaders. She's a dietitian based out of Kansas City, Missouri, who's one of the thought leaders in intuitive eating across the US. Frank Bach, who's the principal product designer for Headspace, as well as Esther Dyson, one of the preeminent angel investors of the entire internet era. Dr. Marta Shea-Sador, who's a quadruple board certified psychiatrist from Columbia, as well as Julie Miller, who's a doctorate PhD from Dan Ariely School of Advanced Hindsight at Duke. So we're raising a $1.1 million round. We've already closed 800,000 of it. And really the key focus of this, again, is we already have the product. We already know it works. Over 73% of people who use Whey notice that they're thinking differently about how they eat, or they're actually eating differently at the grocery store or restaurant in the first week. But now we need to scale that out to as many people as we can, as quickly as we can. And so we want to get to, off of this raise and raising the last 300,000 here, get to about 145,000 in MRR, about 1.7 million ARR. And that will, right now at a $6.5 million cap, that'll significantly push our valuation up potentially 3 to 5x just in the next stage, while getting to cash flow positivity with higher margins. So that's pretty much it. Just happy to answer any questions, and thanks in advance for the attention.
Great. Ray, if you want to come up and ask any questions, that would be great. It looks like Maria in the audience also has a question. How does Whey compare to Noom?
Yeah, great question, Maria. And thanks for asking it. I think the most important thing to note is that Noom has a CBT layer of questioning that they do, but underneath it is a green, yellow, red system. And they're deciding what foods based on caloric density fit into that green, yellow, red. And so they've come under a lot of fire from the dietitian community at large in the United States, as well as behavior scientist community and mental health community, because 1 in 4 people who do a restrictive diet will develop an eating disorder, and 35% will develop disordered eating. And ultimately, underneath the hood, although Noom has done a brilliant job with marketing as a stop dieting as their main headline, they're a restrictive diet underneath it. And so they've gotten under some controversy here, and we've heard across the board that there are very many potential partners in celebrity and in social media that will not partner with them, even despite their growth, because of the difference between their advertising and what they actually are, which is a restrictive diet under the hood. So their failure rates and their success rates are, I'd say their high failure rates and low success rates of people at the 12-month mark are indicative of a restrictive diet. They're almost exactly aligned. And so that's the main difference. We are not that. What way is, there's nothing that is restrictive about what we do. And actually we've meticulously designed way to, from the messaging standpoint and the design standpoint, to be non-triggering. It's really important that we don't trigger people back into diet culture, back into shame, back into guilt, because then we get back into that restrict binge cycle, which ultimately creates failure and affects people holistically in their life. Does that answer the question, or follow up any other questions based on that?
We'll have to wait and see if Maria responds. But in the meantime, Ray, if you have any questions, feel free to ask as well.
Yeah, Bentley. I mean, the role that I'm playing here is to provide some critique on your presentation. I think, the progress you've made is significant and it's notable. But, I've got lots of years, 35 years of raising capital, and I know what investors are looking for. They really need to understand what you're doing. So maybe a case study would be really helpful, or a couple of case studies showing exactly how someone might go through the process with you, so that resonates with people. Because investors invest in things that they understand. Invest in things that they would use, that they feel that their friends would use. So it's really, really important to hit the hammer or the nail on the head with exactly how does your system work, and taking them through that. We all know there's a big problem, there's a big market. We see that you've had some solutions, some success. The metrics are very impressive, really good going for this stage. It'd be nice to know how much you've spent to get here, what your gross margins are now, and how much you plan to spend. When I look at 1.7 annual recurring revenue, that sounds great. But if your expenses are 1.9 million, annual recurring expense, then it's not going to be that great. So you really need to, maybe I missed it, but I didn't see it in there exactly what you're projecting. And then, of course, as I mentioned to Sean on the last thing, you've got to really tell people how you make money, and then how they make money, and very specifically, because we all know what gross margins are. We all know what recurring revenue is, but you got to say, look, we think we're going to make this kind of money on each customer, and then we think we're going to have 20,000 customers, and then this is going to add up to these many dollars. And then here's what's going to happen with the exit. You've invested at this valuation. Here's what our valuation is today: higher, low, better, good. And we hope to find an exit, within 2 or 3 years. And here's a lot of companies that have. Here's other companies in our space that have exited at 5 times revenue or 5 times recurring revenue, et cetera. So, you're really lay it out to people, because we all don't invest because of fear. And we have fear when we don't have knowledge, don't understand something. And we all invest primarily because of greed. We want to have a return. Nobody invests just to get their money back or to lose money. We invest because we want to have a return. So you got to really lay that out for people and make them feel very, very confident that they're not going to lose, and that they're going to, get a return, and that you guys are keeping a close eye on those things. That those are important to the market, and how you, make it very comfortable and so forth. But yeah, the retention rates are off the chart. I'd like to really know how you line up with competitors, because it occurs to me that there's a lot of competitors in the space, and what your unique marketing, because on all these systems, the biggest cost is marketing, right? How do you get people, and it can't just be word of mouth, right? You've got to have social media and all these other things, and they cost real dollars these days, because everybody is competing for mind share. So it'd be really good to know, what is your unique angle on how you're going to get thousands of people to find you, then trial you, and then adopt you?
Yeah, no, those are great questions. And I have a lot of good notes from that, Ray. I appreciate you sharing that.
Yeah, and maybe that last one is just worth addressing for anyone else listening, is what is your unique marketing process that gets you the customers that you've had, this 300% subscriber growth?
Yeah, so we've gone solely to get to this point, we've gone off of paid and organic social media, but we're expanding right now. And so the expansion is going from increasing our ad spend was no more than $6,000 a month, going up above $37,000 a month, and going into different channels, right? So going back into Google, going into YouTube, and also going into, obviously we have to go into TikTok because our audience is 18 to 30 years old and predominantly female, and that's where they are. It's just where they get the information.
Sure. Have you
I think
taken a look at
the
what
thing that you said,
6,000 grand or 37,000 a month buys you in terms of subscribers, and then broken
Yeah.
that down into what the payback is?
Yes.
Is the payback 12 months or 6 months?
So this is totally, yeah, I mean, so basically right now with our retention, we're at about a 3.3 month length of retention, right, with the customer. That's where our ARPU comes from. And what I was bringing up this slide for is because your comment on the gross margin is exactly right. And I think what you pointed out to me, honestly, Ray, is like, I need to spell out the exact gross margin. And then also too, like you said, like lay it out there. And then also too, here on the right side, we have what our goal is. So instead of here just having 2307 and 1019, spell out that that's roughly a 50 or 55% gross margin, and then say, look, we're trying to get to 87.5. We're expanding ARPU up, and we're reducing CAC down even further as our goal.
And show the return on investment,
because
because if you're going to spend 37,000, like
right.
most internet marketing things, they've got to have big spends. I have a company right now that spends $1 million a month, and they tell me every month, here's the justification, because we're generating $1.2 million in revenue. So as long as you're generating,
that's exactly it.
Yeah, so
and I think
you can tell that story better.
Absolutely. Yeah, I think we definitely can tell that story better. And I think that's an astute point. Just like lay it out for people exactly where the margins are, and then also too where the
and Bentley, the reason that you have to do that is really simple. Whether you're talking to an institutional venture investor like me, or you're talking to an individual, there's one truth, is that when somebody sees a presentation, they go back home to their spouse or to their best friend or to their accountant or their lawyer or their investment committee. And within 5 or 10 minutes, they have to tell that person or persons why they're going to take 100,000 or $1 million or 5 million out of the bank and send it to someone they've never met before. And if they can't tell you really quickly, even after the initial presentation, they're going to get feedback, they're going to get negative feedback, and they go, yeah, let's just pass on this one. So if you can make it really compelling in the first presentation of why they should invest and why there's low chance of losing money, downside protection, and big upside return, and they can communicate it. Like I learned this once when I gave a presentation to a guy who was going to invest $500,000 with me. But he wanted his brother to hear it. And then the brother came and he goes, I like it. I still want to invest. Well, I want my father to hear it. And after the third time I presented it, he said to me, now I get it. Now I'm ready to invest. And I thought, what an idiot. It took you 3 times. And then I realized I was the idiot. I didn't explain it to him simply enough, a guy that wants to invest 500,000, that he understood it the first time. That was my mistake. Right. And I committed to never do that again.
And my question to you on that is exactly, it's a great lesson, and I appreciate you sharing it. And I think that the experience that I've had, but the question that I have for you right now, given the vantage point that you see, because I've seen from so we have a fund that's an investor, we have and then a mix of family offices and angels that have invested so far. But I think that the thing that I'm curious about is, in this environment, to say what a return is means that we're projecting a multiple, projecting a valuation, and then comparing it to where it is today. And I think that the question is, like, how do you see doing that without losing credibility? Because I feel like that could be trust is built one drop in a bucket at a time, and it's kicked over really quickly.
Yeah, absolutely.
And I feel like that's one of those.
Sort of the point that I made to the last speaker is that some of his facts and things seem like exaggeration that undermines trust. But here's the point. For many years, when I was giving fundraising presentations, lawyers told me, don't say anything about returns. Don't say anything about projections of timelines, like keep all of that out. Like lawyers don't own businesses and they don't sell businesses successfully. Yeah. So I threw all that out. Now, what I like to say to people is, if we achieve, these are what our projections are on revenue, earnings, what have you, based on our conversion rates, and show them very specifically, simply how you do that. If we achieve that, then this is what we believe the multiples will be, because there's other companies out here, and you can go right to PitchBook or CB Insights, and you can find companies just like yours that have raised money or had exits at certain multiples, and you show a range. You say, and look, we don't know if we're going to do that in 2024, but if we do it in 2024, here's what we think will be worth: 5 to 6 times our revenue, or 5 to 6 times our recurring revenue. So you blanket it with, if we achieve this level of revenue, and the market conditions stay the same or get better, we believe we will achieve this multiple. In which case, if you invested $100,000 with us today, your money, all those things come true, will be worth this tomorrow. And then people go, oh, 4x return. Love it. Like it. Makes sense.
Absolutely. Absolutely. And I think that my only last question here, because I know we're probably wanting time and I want to make sure that everybody has time. So I think Maria has a quick question too, but I guess my only question back to this, Ray, was, my intention with this presentation was to make it short so that it would create just kind of like the decision on the interest to have a further meeting to dive into deeper details. Do you think it's worthwhile to have all that upfront still in this setting?
Yeah, short is good. Short is good because you want to qualify people, but you got to tell them the most important things, exactly how you make money, because everybody's got $1 billion market. Everybody's much better than their competitor, like every single deck. I've never seen a market where a guy goes, we get this really small market and our competitor, some of them are better than us. I never hear that, right? Never, ever hear that. And it, even though it's true. So the most important thing is very specifically understanding how you make money, because for some people, unless they're in this industry and unless they've seen your product and you've explained it to them through, you got to tell them very specific how you make it, why it's likely that you're going to try to achieve these results, how they're going to make it, when they're going to make it. Is it going to be 2 years? Is it going to be 5 years? And what are the actual reasons why it's unlikely that they'll lose their money? You imply it, great team, great model, great retention, but you got to emphasize it, especially at the end, because in a presentation like this, people remember the last thing you said. And if the last thing that they hear is some guy in Florida ranting about what a good deck is, that's the last thing they're going to remember. You always want to, after the Q&A, go back to say, hey, let me give you my last slide. This is the takeaway. And then you hit those points so that they don't remember some guy who thinks he knows everything, and they remember you and your good points and your good deck and why they're likely to make a lot of money and not lose money.
Right. Yeah, no, I appreciate that. Thank you. Thank you for sharing that. And I think
Maybe go to your last slide. I've got just a reminder.
I got some good notes. Yeah, exactly. Right. I think on that note, there's one last question that Maria had, I think, around the program. If it doesn't restrict calories, how does it retain or attain results and keep participants engaged? I think, Maria, I'd be happy to follow up with you, but basically, intuitive eating, I think there are 150 clinical studies on intuitive eating. The ones that we look at that are the ones that are published on PubMed and NIH are the ones that where long-term success of intuitive eating modality and method is about 76% when measured by weight loss, compared to diets, which are about a 17%. And so ultimately that's where we see a huge gap in long-term performance, and that 76% success rate with intuitive eating also lines up with what we're seeing in the success rates of our customers. So weight is one of those areas that we can talk about more deeply, but I'm happy to send you some of those studies if you'd like me to.
Great.
Awesome.
That's about all the time we have today. So I want to thank Ray, Sean, Bentley again for their great presentations. And again, if anybody is watching this recording, please send me any feedback or questions you have as well. And to everybody in the audience, we're going to be sending our follow-ups and make any necessary connections via the polls and everything else we talked about today. So with that, again, I want to thank our presenters, and I hope to see you next time.
Thanks again, Shane.
All right, bye, guys.
Have a great day, everybody. Thank you so much.